Hello, everyone. This Will, aka Dr. Financial Literacy, continuing on this wonderful journey of using velocity accelerated banking. Many of you may not have heard of the term, but as a political economist, that's one of the things that we do as social scientists. We look at the world around us and we develop concepts. The concepts of velocity banking and accelerated banking was also developed by others. As a social scientist, we try to be a little bit more precise in terms of developing concepts, looking at it, the world around us, and see how it actually works. So that's one of the things that I'm doing personally. I'm doing with my clients, and I'm doing for the community in general. So in looking at the mortgage that I was able to pay off by being blessed with the HELOC, I wanted to just go back and look at my federal truth and lending disclosure. And it's the paperwork that you get when you purchase the home. So this was the paperwork that I pulled from my files where I purchased the home, and I just wanted to go through just some more information with you as I continue along this path and this journey in helping others. So in looking at the home that was purchased that I had, and that was also paid off by the HELOC, one of three. So I still have two other mortgages that I'm having to pay off, but the HELOC has sped up that process, and I'm continue to see how it goes. So if the original price of the home was $61,500. It was a condominium, well, a townhome that I purchased in 2008 during one of the capitalist crash of the system in general. The system continues to crash and it's cyclical. The best you can try to do is to see how and when they occur. Of that $61,000, the principal balance that was left after closing costs was $57,202.61. Again, in May of 2008, I purchased the townhome for $61,500, and the principal at the closing costs was about $57,000. Now, that price was when the market was falling in the Atlanta area, and they continued to fall. As I watched throughout that particular year, the lowest one that I saw within the area that I was buying was about $24,000. So if I could have waited a little bit longer, probably could have got a better deal. All right. Now, if I would have maintained this mortgage before the HELOC, I would have ended up paying $125,000 and $78.40 over a 30-year period. So that's 30 years if I would have went the full length of the mortgage. The monthly payments was $347.44 on $57,000. I ended up paying 180 payments at $347.44, which means I paid $62,539.20 of the $125,078. That means I had about a little over $62,000 to go, and I had another 180 payments to go before the HELOC. The HELOC cut this down to it cut it down 180 months. So as many of you know, I'm now mortgage free as a result of the HELOC. Now, if I would have also gone the 30 years of the mortgage, that would have been a 130 I mean, a $103% increase in what the original balance of the home in which the bank would have obtained in interest. That is the cost of money. That is the cost of money. That's not me buying the bank a house. It is the cost of money. I did not have $61,000 to get this $57,000 home as the market was crashing. Throughout the history of the country, certain groups may not have had access to a loan to get it. So when I was given the opportunity to get a loan to pay the bank $62,000 in interest, I jumped at the opportunity because historically, some groups may not have gotten an opportunity to get the loan, to get into certain neighborhoods, to build equity into a home. So I was fortunate enough to say, hey, bank, I'm going to give you $62,539.20. Now the value of the home is $220,000. So I gave the bank their 62.5339. That's the cost of borrowing money. Now, if my mom would have had the money, came from a single parent in public housing, then no, I would not have had given the bank or potentially give the bank $62,539. Now, I have heard some stories where some individuals, their mother or father provided them 10, 15, 20 some $1,000 to get into a home. I've heard where there are some cultures and some groups where when a man and a woman get married, the two families, I think, provide a house or a large lump sum for the couple to start off. I wasn't that fortunate. I didn't live in a community that was fortunate. I wasn't a part of a dominant group that had the resources like that. So, okay, here you go, bank. Here is your money. Willie is willing to pay the cost of the money because he or his family does not have resources, but now he has an asset that he can use that can continue on the trajectory as a result of being provided a loan. Now, the government had to step in to make that happen. Okay, so the interest rate that the bank provided was 6.118 on the loan that I received. My first payment on that loan was 6/1/2008, and if I would not have gotten the HELOC using the velocity accelerated banking concept, then I would have ended up at 6/1/38 30 years later. So I'm thankful and be blessed that the bank saw that, hey, maybe through government intervention, all right, we're going to give Will a house. We're going to give him an opportunity. We're going to give him a time within the community because structurally we have done things in the past that prevented it. All right. So with the HELOC, I was able to cut that interest in half. So I just wanted to come on today and just look at the loan that I received almost 15 years ago that provided me an opportunity to build wealth within a capitalist system that often has structural and systemic barriers in place. I've taken that opportunity. It is what it is. but it is what you make of it. So this is what I made of the bank attempting to get $62,000 in interest. The cost of money. In renting my property, there's a cost of money. Are my tenants buying me a home? No. It's the cost of money. I still had to pay the taxes. I still had to pay insurance. I still had to pay lawn. I still had to pay other services. I'm still had to put a roof. I still have to pay HOA. Are they buying me a home? No. It's the cost of money. So the banks ain't buying me a home. What they did was provided me resources. I paid their resources back. The cost of money. Economists call it opportunity cost. Opportunity cost. When you get a chance, look it up. Opportunity cost often refers to the use of resources to do one thing where you can't do another. So the bank engaged in an opportunity cost to provide me resources when they could have did other things with those resources. I engaged in opportunity costs where I could have used that $61,000 to do something else. I could have went on trips. I could have eaten out. I could have had hobbies. I could have purchased a car, rims, some fancy clothes, travel. But I decided my opportunity cost will go into an asset that someone was providing me the resources to. So in closing, opportunity costs come your way and you decide if you're going to engage in those opportunity costs. Again, I'm a political economist. I am not a financial advisor. I am not a certified planner. I'm not an attorney. I try to look at the data. I try to come up with concepts. I work with clients and we try to figure this thing out. So this is just one of the mortgages that I was successful in paying off with a HELOC along with other things. So I had a couple other things wiped out also with the HELOC. So I got 2 more mortgages to go, 150 some thousand in educational expenses to go. My bills have come down. My credit has improved. The numbers are lowering. So if you want to find out how I can help you and you can engage in some opportunity costs, give me a call or email me and we'll see what we can do. All right, I'm out. Have a great day.